Hello, my name's Scott Trevethan and I'm the founder and CEO of Financial Fanatics. Today I'm answering the question, just what language is my bookkeeper speaking? What I'm really talking about here is the use of accounting terminology, which sometimes your bookkeeper or accountant can assume that you understand, but it isn't the most common usage from business owners' perspective. So, first of all, let me talk about what a bank reconciliation is. In the olden days, there used to be checks that were written for payments. So the bank reconciliation was just trying to work out the difference between what your books of record, that is your general ledger, or what the accounts that you would show shareholders and your accountant, and the actual bank statement, why there was a difference between what the bank said you had in money and what your book said. So that was a reconciling the two things together. Well, now that we have very fast digital based cloud-based accounting systems like Xero, QuickBooks or MyOb, the bank reconciliations are something that happens a lot more fluently. So we're just making sure that every transaction that goes through the bank statement is accounted for in your books and records. The bank statement, that is what's known as a single source of truth. And that's why the bank reconciliation is such an important part of bookkeeping and your day-to-day financial management. The next one is what is depreciation. You hear this term depreciation, and all it is spreading the cost of an asset out over its useful life. If you buy a motor vehicle and that motor vehicle is going to be of use in the business for the next 4 years, then you can spread the useful life of that motor vehicle over 4 years. It doesn't make sense that you would expense it all in the 1 year and then get to use it for years down the track. So that's all depreciation, is trying to allocate that cost of the purchase over the period that it's going to be used by the business. Coding's another term that people go, what are you, a computer programmer? Coding is just allocating a chart of account code or a line item on your profit and loss or balance sheet per each bank statement line. So making sure that your expenses are coded or put to the right bank statement or profit and loss or balance sheet line to make it appropriate for you to make sense of your financial accounts. Amortization is just a spreading the interest on loans that you might have, like a hire purchase loan, over the period that it relates to. So sometimes with hire purchase loans, you pay more interest up front and less at the back. So amortization will just make sure that that interest is spread accurately and according with the tax and accounting standards. Accounts payable, or sometimes creditors as they're called, and also accounts receivable, or sometimes debtors. Now, as an accountant and a bookkeeper, sometimes we just assume that these terms are easy to follow and everyone understands what they are. But accounts payable, or creditors, is just money that you owe other people. So when you buy something from a supplier, then the money that you owe them because you didn't pay cash, they gave you credit, that's an account that is payable. That's hence the term accounts payable. And the more archaic term, creditors, because they gave you credit. Accounts receivable is the opposite. So you've given an account to someone else and they are going to be giving you the money back. So these are your customers or clients that you've invoiced and you're waiting for them to pay you. Also known as debtors, and I'm sure you've heard of the term of debtors, prisons and all sorts of things. People owe you a debt because you've given them a supply of a service or a good. So that's what's going to need to happen. They're going to need to pay that back. Gross profit. Gross profit is all of the sales less the cost of those sales commissions, some bank charges and fees, your net sales number, that is, less all the direct costs attributable to making those sales. So that could be the cost of inventory if you're selling a good, or the direct labor that goes into supplying a service. That equals your gross profit. And the gross profit is what you need to meet all of your fixed and semi-variable expenses. But I won't get into more jargon when I'm trying to explain accounting terminology. EBIT and EBITDA, these are common terms. EBIT is just earnings before interest and tax, and EBITDA is earnings before interest, tax, depreciation, and amortization. Now, those numbers are important because what they show, notwithstanding the tax situation and how much money that the business owner borrowed, it helps when you look how your business is performing compared to someone else's. Then there's profit and loss. It's just a statement that shows your revenue less all of your expenses equals a profit or a loss for a given period of time. And then there's a balance sheet, which is all the things that the business owns less all of the things that the business owes. And that gives you an equity perspective, or what the business net of those two things really is. And that's going to be at a point of time, not over a period of time. That's about it for now. I hope that explains a little bit more about bookkeeping terms. Remember, there are no silly questions. If you don't understand what a bookkeeper or an accountant means when they're using these terms, just stop and ask. They will be more than happy to explain their understanding and knowledge of the term. And if they don't, there should be some serious questions raised. So always ask the question. If you'd like to get my free ebook, which has a chapter on all of the different explanations of what bookkeeping and accounting terminology, please don't hesitate. We'll put a link on this email below. I'm Scott Trevethan from Financial Fanatics. Bye for now.